All right, good morning. Today is Thursday, July 27th, 2023. Welcome to this month's Capital Markets Update and Outlook call. Today, we're going to hear from our Chief Investment Officer, Tom Fox. Tom is going to review the positives in the markets, the headwinds, as well as give us his outlook for both for the rest of 2023. Ultimately, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in the markets and the economy and what we are watching for. So with that, I encourage questions. I encourage you post questions in the comments section. I would love to field those for you, get them to Tom. You can also email me. I'll be monitoring my email box. If you have any questions throughout the presentation, we would love to answer any questions that you have. But who am I and why should you even care what I have to say? So, my name is Eric Hagan. I'm a financial advisor. I am also president of Capital Consulting Group. I, of course, will be joined here today with our Chief Investment Officer, Tom Fox, as I said. We also, you might be a client of Dan Oshman or Rana Grant. If you are a client of financial advisors, Dan Oshman or Rana Grant, special welcome to you as well here today. And then CCG also consists of our client support team, John Knudsen and Marilyn Westmark. Together, our goal is to help individual investors and individuals, couples, families make their next financial decision and the one after that a good one. So why should you even care what we have to say? Well, at the beginning of 2023, and really even back to 2022, the recession drumbeats were so loud, it was deafening. Market pundits warned that as the Fed raised interest rates, it was just a matter of time before the economy entered a recession. But it's July now, practically August, and so far, no recession. Despite all the gloom and doom in the media this past winter, what is playing out today is in line with what we were saying before 2023 began. What you're looking at here is the summary from our monthly update for December of 2022. We said to expect a soft landing or a soft recession. So far, that's what's happening. We said to expect corporate earnings to come down. We thought it would be a bumpy ride with high volatility in the markets. We said a high probability of double-digit returns. The stock market, as measured by the S&P 500 index, is pushing about 20% up year to date as of today. Said the S&P 500 would be at 4,600 by year end. We already hit it. We're knocking on the door of it right now as I speak. And we said that there would be explosive upside in stocks and bonds around mid-year. And that is exactly, again, what's playing out. Now, it's too early to wave the checkered flag, but all of these things have occurred or are occurring. And that's why I think it's important that we pay attention to what Tom has to say. With that, our agenda for today is to hear from our Chief Investment Officer, Tom Fox. He's going to talk about the headwinds in the markets and the economy. He's going to talk about the positives and then give us his outlook for the remainder of 2023. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, really focusing his attention on the economy and the markets. He's got over 35 years in experience and a very, very long resume, as you can see on the screen here. So again, as Tom is speaking, you have the wonderful opportunity to ask any questions of him. Please feel free to put those questions in the comments section or to email me directly. My email is eric@investwithccg.com. I'll be monitoring both and would love to field any of those questions for Tom. So with that, I'm going to bring Tom on here. Give it a second to connect. Tom, welcome.
Thank you, Eric. Hello, everybody. Good morning.
No pressure today.
No pressure. Yeah.
You have been doing
so
a great job.
We did get a lot of things right. And I think all our monthly updates that you've seen us do each month has been really accurate. And I don't know if you remember, but when we called 4,600, I think we might have been the top analyst in terms of the highest number in the S&P 500. But through the grace of God, we've already hit 4,600. So we're excited about what we said back in December. That's pretty amazing, Eric. But I don't want to start patting myself on the back, because I've learned in the business, as soon as you pat yourself on the back, you get your butt handed to you. So I've learned too many times you can be right, and then you can possibly be wrong. So, but through God's grace, we've done really well. So let's take a look at what we're thinking right now. So I always like starting off with what the other strategists are saying, and we look at this. It's not like we're on an island by ourselves, but we certainly look at the thoughts and the intellectual uh, mindset of what other analysts are saying. And there are a lot of intelligent people out there, a lot with a lot of experience. So, but I do look at this and I incorporate this in all of our decisions. And here are some things that strategists are saying. And I just got this in an email the other day. We're experiencing a bear market rally of the ages. Well, I don't know where he's coming from, but he's the MIT graduate, very good and smart analyst, strategist. But he thinks we're still in a bear market rally. Well, we blew through the bear market rally, and he says it's a bear market rally of the ages. Well, technically, we are a bull market. He's saying it will reverse soon, but that's not going to happen. We've already proven that wrong. Anyway, euphoric markets are being fueled mostly by hype around AI, tech, and slowing inflation. Well, that in our mind is not hype. AI tech is going to be starting to be incorporated already, but it will really hit the fourth quarter of this year and all of 24. We'll see the companies taking advantage of the cognitive AI that has now been developed, and it's going to make everything more efficient. Their profitability is going to go up, but that starts in the fourth quarter and into 24. It'll just start moving forward. So we're excited about that. It isn't hype. It's going to happen. It's going to make our world much easier. And slowing inflation is not hype. It's happening. We're seeing slowing inflation. So in our mind, this is not hype, but it's an actual reason to get excited about the markets. The rally over the past 2 months implies macroeconomic scenarios that are even more positive than a soft landing. I think that's a really interesting statement. And so that the stock market is a forward-looking mechanism. So always, when you're in a bull market, which we are now, it looks out about 6 months. So we see a very positive 6 months coming. We will expect a pullback. We'll talk about that in a later slide. So that is an interesting one, and I'm keeping an eye on that. Another one is when stock market reaches today's valuation levels, prices fall to resolve the divergence. That's a true statement. And that's why we do expect a pullback coming. We'll talk more about that. Inflation will remain sticky for a long time, and the Fed will keep rates high for a long time. Now, we're kind of in this camp. We think that inflation will not be totally sticky. We think it's going to keep coming down. So we're not really as sticky as that they're talking about here. But we do think that rates will stay high for longer, but not for a super long time. We think probably the rest of this year. Much of the market thinks rates will start dropping this year. We do not. So we kind of believe this one, but we don't think it's going to impact stocks and bonds in an overwhelming way. Inflation will remain, delayed impact of the global interest rate shock, real estate, consumer credit, quantitative tightening, and liquidity is coming soon. Now, that is something that we are watching, and because we do believe that there could be some impact from those because of the consumer credit tightening. And will small companies be able to get the loans they need? Will commercial real estate blow up? That is something like office buildings. Is that something that's going to happen because of the new exciting way to do work, and that's working from home? And right now, by the way, I'm working from home. I have two offices, but this is the one that's at home. So yeah, do I like it? You bet I do. I got my shorts on, in fact.
Show us the
I'm not going
shortstop.
to
Yeah.
show you that, but I am in my shorts. So people are working from home. Well, that impacts people coming back to the city, to office buildings, and do they really need all that space? So that is an issue, but there are a lot of people buying up the commercial real estate at discounts. So I think the liquidity will be there where companies are going to come in and get value and buy up the real estate to keep it from a disaster. But that is something we're keeping an eye on also. There's fresh signs of emerging overseas economies are far from healthy. Well, France and Germany, PMI was not what we expected. It came in lower. So Europe is still struggling. That's why we're invested here in the U.S. because U.S. is really doing well relative to all the other countries. But it has some impact on the U.S. Because they're consuming some of our products and services. But Europe's not doing as well as the United States. So that's something we're keeping an eye on. And also, weakest economic quarters are still in front of us. Hard recession coming soon. We don't believe that at all. I mean, we could have a slower economic GDP growth, but we do not see any hard recession coming soon at all. We've been said at the beginning, soft landing, soft recession. I'm moving the recession till next year, but it will be soft. So we're in a soft landing, or maybe no landing. So we think our economy is doing much better than most expected, and it is. We just came out with a GDP number, which was very, very good. Now, here's another one that's going to have an impact on the economy, and that's student loan payments starting to kick in. Average about $250 a month for students that have loans, and that's going to take away a lot of their spending money. So that adds up. And so that could have an impact on the economy. And we're going to have to follow that and see how big that impact is. But overall, I would say most strategists, institutional investors, hedge funds even, have been very bearish and expect lower lows than the October of 22. We do not. And we'll talk about why. All right, there are positives. Why should you be buying stocks? Well, inflation's glide path is going in the right direction. It's heading down. And we think there's momentum in the decline in inflation. And so we do not expect that to change. So we expect lower numbers coming up each month as inflation continually, slowly keeps falling, but it's heading in the right direction. Early corporate earnings so far this quarter have been positive. We've even had a few more today that announced great earnings. And so the earnings recession that people called for all year long is just not, it's not here. It's not coming. So we were right on that. And so the earnings have been pretty darn good this quarter. Now we do think, because analysts have lowered their estimates to the point where now we think they're going to have to start raising the estimates. So we think there's been a kind of a bottom in the trend for analysts to lower estimates. Now we think they're going to start raising estimates as we move forward from here. Fundamentals look positive still. And so we think that because the fundamentals are looking good today, that any downside, which we expect a little down pullback, will be limited. We don't think it may be 5%, maybe 7% at the most. We don't even see a correction in the future right now. If correction technically is 10%, we do not expect that at this point. Stock and bonds typically rally after the Fed stops. We believe they probably have had their last interest rate hike. Now they're going to be data driven, and we expected that they would say that yesterday. So we do believe that the Fed is probably done, and that is a great moment for stocks and bonds. Typically after a rally, will rally after the Fed stops. And we think they have stopped. They may do one more, but we don't think that would be a big issue. But we think they've stopped. We think it's the inflation rate's going to continue on a downward glide path. And so we think they're done. That's good for stocks and bonds. Economy remains resilient. And everything that we see shows that the people are still spending, they're still traveling. And many of you that are listening probably have been taking some trips. And so we think that's going to continue for some time. And so we don't see the economy falling off a cliff. Now, we could end up with a softer landing, but we do not expect a recession until next year. Household, and it will be a soft one. Households still in good financial shape. There's low debt service. If you look historically, the debt income, the debt ratio, debt service, it looks very good. So we're not back like we were back in other years like 2008 and where we had high debt service. No, the consumer, the households are looking good. And this should uphold the spending patterns of retail. So we're looking forward to that to continue. Huge amounts of cash on the sidelines. Wow, there's a lot on the retail side. There's a lot in the institutional side. What if that money turns bullish? And we started to see some money come back in, but not a lot. So what that tells me, if they throw the towel in, because a lot of institutions have been maybe 25% in stocks, hedge funds been on the wrong side of this bull market. What happens if they throw the towel in and they decide to go bullish? Well, there is so much gunpowder on the sidelines that could move this market dramatically to the upside. I don't know what it's going to take because you would have thought they would have come in a while ago, but there's still tons of cash on the sidelines. Overwhelming number of institutions that have been bearish. This to us is a bullish contrarian indicator, which means that when people get overwhelmingly bearish, that's a sign that things are going to get better. Because typically when you get that many people saying the same thing, it goes the other way. So we had a strong beginning in the S&P 500 after a down year, and that typically leads to a great second half and total year, and especially after the negative year we had last year. So we think that this is going to be a good year. And you'll see at our last slide what we predict. We've changed our prediction, our forecast for the market. So you'll have to wait and see what that is. All right, stocks have surged from October lows. Officially, we're in a bull market. We're not in a bear market rally of the ages, like somebody just said the other day. But we're officially a bull market, earnings and revenues beating estimates. So we'll look at some of that in the charts. So here's how much the stock market has surged. It says 76. It's already moved 2% more than it reached 78% from October lows. How many believe that's a pretty good move in less than a year? 78%. And just think, a lot of strategists were on the sidelines. They weren't invested in stocks. A lot of even hedge funds weren't invested because their macroeconomic analysis said that we were going to go into bad times. We're going to go into recession. We're going to go, corporate earnings are going to fall off the cliff. A lot of these things that we were on the other side have not taken place. So the markets moved and reached 78% from the bottom. That's a huge move. And so we think there is going to be a pullback. And you can see the line. If you take a look at the line from the bottom, goes up and then down somewhat, goes up and then down. And then we've had a long up. We do think it's going to come down there. And you can see Eric's marking there. So we think it's going to come down, but we see higher highs to the end of the year. Okay, this is the earnings so far. Now it's only 26% of the S&P 500 companies, but 77% have beat their earnings estimates. And that's by a whopping 7.9%. That's big. Now we've got 74% more coming over the next several weeks, but this is a good start. We still do not see an earnings recession or earnings disaster coming, and the numbers are proving that out. Revenues were up 64%, or beating at 1.6. Now that's not as good as the earnings, but it's still decent. So even the top line is still decent, but we're not seeing any kind of disaster going on in revenue or earnings. All right, here's contrarian indicators. Stock sentiment is very bearish. This was just brought out by J.P. Morgan, and they did a survey of how many institutions are planning to raise equities over the next week or so. And you can see that only 17%, that's a low since June of 21, have plans to raise equity exposure. That's a contrarian indicator. That's saying that people are very bearish. But we'll see how this pans out. But it's historically positive for stocks. All right, how many people are short in the future markets? And short, what is that? That means you're betting against the stock market. You're saying, I'm going to bet the stock market goes down, so I'm going to short the market and I'll make money if the stock market does go down. But you can see we've come off the record low. That's a record low if you see it over in the right. And we've come off of that, but we're still at historical lows. If you look across to the left, we're still very bearish. And you have this many people short, eventually they're going to have to cover. And this is another reason why I think our downside is limited. Because if it does go down, maybe 5%, maybe 7%, we do not expect they're going to stay short. They're going to probably cover and go long or stay out of the market. But we think there's just too many people that are negative right now. They've been negative all year, by the way. You can see, I can't see the date. Yeah, since the middle of 22, they've been negative. And guess what? They've been dead wrong because the market's up big time. So all these people have lost money. I'm just wondering when they're going to throw the towel in, Eric. I don't know.
Yeah, that's fascinating.
It is fascinating. Okay. So this is not hype. Inflation is cooling globally. Now, this is the US. You can see headline, which includes energy and food. And then the core is less energy and food. And the reason is because they're more volatile. But you can see the numbers are coming down. And look at the headline inflation. It's falling like a rock. This is good news. And we don't think this is hype. Here's the facts. It's really happening. And we think that pattern is going to continue. And, the Fed's target is 2%. Well, we're getting close.
I haven't seen that image in a while, the falling like a rock, but you were using that a lot last year of what to expect with inflation, and that's looks like falling like a rock to me.
That looks like falling like a rock. Well, is that your stock portfolio? That's if you're short. That's what
If you're
your
short, yeah.
portfolio look like. All right, here's globally, developed markets and emerging markets, but you can see they're all heading down. At least both the headlines are falling hard. The developed markets, and that's the whole world, US, Europe, and so on. And you can see that that's kind of flat there, but that's the core. But the headline are all falling going in the same direction. That's good news because the overseas inflation will impact the US inflation. All right. I want to talk about bonds. We're bullish on bonds. Now, I got to say this. Most strategists remain overly optimistic about rate cuts this year. We do not think the Fed is cutting rates this year. As you can see, this is the overall average of analysts' expectation. They think the Fed's going to cut this year. We do not, but we don't think they need to for the bond market to rally. We think they're going to hold all year, and we do not expect any cuts until maybe mid 24, maybe the first quarter, end of the first quarter, but we'll see. We don't see the Fed cutting. We think they're just going to hold where they are. Now, there is one caveat to that. If the economy rolls over, and we're not expecting that, but if it did roll over, of course, they're going to have to cut, but we don't see that happening. However, this is a chart historically. What happens when the Fed is done? And this is the 10-year bond yields. Rates fall. And you can see that they fall quite a bit. And this is every scenario here. This is interesting. Since 1989, this includes 89. This is every time the Fed got done raising rates. Boom. The yields fall. And when bond yields fall, what does that mean? Bonds go up. And we're going to look at a chart on that. Now, if you look at 2006, and that's the orange one, and it fell for the first 6 months or so, and then it started going back up. We may have a scenario like that, but we do expect that 6-month rally to take place in bonds. And we, again, think the Fed is probably done. Now, the reason bonds aren't rallying right now is because the Fed said they're going to be data-driven. They're not saying we're done. They're saying, hey, we're data-driven. But we think inflation is going to continue to its momentum downward. So we think that they're probably done. I mean, we could get one more 25. We don't think that's going to impact the market much, but we think if they did one more, they're completely done. So over the next year, 12 months from now, this is what the scenario that we think is going to happen in bond yields. And we think you could even get double-digit returns in bonds. And what have we done? In the fixed alt, we've been increasing our bond exposure. And we have a few alternatives in there to sort of a hedge if this does not happen. But right now, we've been adding to our bond positioning with this expectation. All right, technically, when you look at the technical analysis, we think that there's been more downside. Whenever you start getting lower highs, that's a good sign. And so we think that the downside is probably around 325 sometime this year, or at least into the first quarter. We will end up at 325. That's a pretty good bond move, and we'll see in the next chart. So the technicals are looking good. We're not seeing higher highs, but we're seeing lower lows in the bond yields. And here's the total return. Let's bring this to where we can see what kind of total return we'll probably end up getting based if history repeats. And so if you look at the 1 year, which is the orange bars, you can see that bonds had a 24% return in 1 year after the Fed stopped. In 87, it was 8%. In 95, it was 17%. In 2000, it was 14%. In June, it was 6%. In December 18, it was 9%. And then 13% is the average. So the average gain is 13% in 1 year after the Fed's done. We're expecting that to repeat. Now, of course, history doesn't repeat exactly, but it does rhyme. And we think that there's going to be a robust returns after the Fed is done. And we believe the Fed could be done right now. So we're expecting great returns over the next 12 months. All right. So what do we got for the rest of the year? We are neutral on stocks right now because we think a short-term pullback's coming. Yet we're bullish to the year end, and we'll see at the bottom line here where we're expecting to go. Corporate earnings have bottomed. Analysts will start increasing forecasts from here. The Fed has stopped raising rates, we believe. Bond yields are heading lower, good for bonds, which we just saw in the charts. Huge amounts of cash on the sidelines could bolster the second half rally, and the second half rally has already begun. Again, we think we're going to get about a 5%, maybe 7% pullback, and then it's going to be off to the races to the end of the year. Markets will remain volatile, but will stay above the October lows. We're not going anywhere near the October lows, even though a lot of analysts think we will. We don't think we're going anywhere near that. Soft recession, I've changed this. I said late this year. I say early 24. No deep recession. Many have been calling for a deep recession all this year, and many are calling for a deep recession next year. We don't see any deep recession, and we've moved it from the end of the year all the way to 24. We expect 2 steps forward, but there will be 1 step back. There always is. So we expect 1 step back. And then S&P forecast 4,900 by the year end. This is a change. This is a change in our other forecasts because we already hit 4,600. So we did hit that already. But we are definitely expecting a higher number now. And we think we're going to hit 4,900 by the year end because we think we're entering maybe a Goldilocks situation where inflation's falling, economy's doing well, unemployment stays low. A lot of good things are happening out there. So we may have Goldilocks to the year end, but we always pull back at some point on the way there. Nothing goes up in a straight line. And we're about 91% invested. If you, for those that are in our thematic, we changed out of the high tech because we think they're more vulnerable in a pullback. And we moved into some things thematically that we believe will outperform and are much safer to go into. So we went to about 91. I think we were what were we at 80, Eric? 80%, and we went to about 91% invested.
Yes.
And we added the area we went into in our thematic was dividend stocks. Why? Because they've underperformed dramatically. But we think there's going to be market breadth or market rotation. And we think that the dividend area is a good area to be in thematically. And then we hope to, on a pullback, go to our fully invested in equities. Right now, we're expecting that pullback. That's why we're at 91% invested in our equity exposure. So we're expecting 4,900 by the year end. That's probably higher than any market analysts out there. But we said 4,600 when I don't think anybody was near 4,600 last year. And we've reached that already.
And that's another 6.5% or so from where we are right now.
Yes.
Yeah.
So we'll end up about 28%, 27% total return.
Yeah, the timing is hard, of course, but like you said, 2 steps forward, 1 step back is a good expectation to have. So far, that's exactly what we've seen all year long. Thank you, Tom. Wonderful presentation. Always appreciate the balanced approach. I know all the people that we serve appreciate that as well. Oftentimes we just get one side of the story. So really appreciate your weight of evidence approach, balanced approach, both sides. Open it up to any questions. If anybody has any questions out there, I see a few of you out there. Go ahead and put it in the comments section. If you are watching this in the recording, you can also comment and I will get those. You're also welcome to email me directly and we would love to circle back with you, whether you're a client or not. Feel free. Would love to field those questions and circle back with you. Checking my email over here. I don't see any questions over there, so maybe a couple more seconds here as I do a couple more things. So just a heads up, you can mark your calendars. Our next monthly update is scheduled for Thursday, August 24th, again, 11 a.m. We will be live in person here at our office in Eden Prairie. You're invited to join us for lunch, or you can join us online as well. And the recording will be available on the website for those of you that cannot make that time as well. So mark your calendar for that. Additionally, if you're not already joining me on Monday mornings, I do a short recap of what happened in the markets the previous week, 5-10 minutes tops. These are the headlines from the last 3 weeks of doing this. I also send out an email later on that day in the afternoon with a link to the recording of it for those of you that cannot join me live, 9 a.m. Monday morning, Central Time. And then let me just check questions here one more time. I don't see any questions coming in, so I guess wrap us up with a little bit of fun. So our annual client appreciation capital cruise, we call event, is scheduled for Tuesday, August 22nd. We will be departing out of Excelsior this year. So we can depart out of multiple locations. This year we will be out of Excelsior, which is different from last year. So if you're coming out for that event, be sure to get the correct directions. Tuesday night should be no problem with parking in downtown Excelsior. We will be departing promptly at 6 o'clock. So you want to arrive a little bit before that. We want to make the most of our time on the cruise. Wonderful cruise, about 2.5 hours, pull back in around sunset, full dinner, music, fun. So something we look forward to every year. If you have not RSVP'd, please head on over to the website when we're done here today or when you're watching this and RSVP so we can get a proper head count of everybody that's coming. So I will take one more glance at the comments section here. Tom, I think we're good. So no questions came in. Again, if you are watching this from the recording and would like to ask a question, don't hesitate to reach out. We will definitely circle back with you. But with that, I'm going to go ahead and wrap us up. Tom, any parting thoughts as we close up here?
No, get on the boat. Let's enjoy this summer. It's been a beautiful summer, and let's have some fun.
Isn't that the truth? Well, yes, and everybody here in Minnesota, stay cool. Been a hot week this week, and we'll look for you on the boat. So thanks everybody for coming out. And again, Tom, thank you so much for your work here today.
You're welcome.
Bye, everybody.